Stop share. Stop
It says
sharing.
we're live now. We're
Okay.
live.
All right. Well,
Perfect. Thanks.
fine.
All right. Well, hopefully everybody can see me. Hello, everyone. My name is Daniel Leitner, and I wanted to thank you all for joining us today to talk about a thought that may be counterintuitive on why there is no need to rush paying off your mortgage. This topic can apply to homeowners and non-homeowners alike. All right. So the thought of not having a mortgage is wonderful indeed, and there are several reasons why people strive for this goal. One is increased cash flow. With no mortgage payment, disposable income significantly increases, freeing up financial resources for other priorities like investments, travel, or helping out the family. Another reason is that sense of accomplishment. Paying off a mortgage early can be a major personal achievement, fostering a sense of control and empowerment over one's financial future. Thirdly, reduced interest payments. The sooner you pay off that loan, the less interest you pay overall. Another reason is the vulnerability reduction. Eliminating a major debt reduces financial vulnerability during economic downturns, job loss periods, or unexpected expenses. And last but not least, that debt-free peace of mind. Eliminating a large debt like a mortgage provides immense emotional and psychological relief, reducing stress and anxiety associated with monthly payments. So, while it might not seem like it, I do see the allure of why a mortgage-free life can be tempting. But before diving into your retirement savings and investments to pay off your home loan, remember that may not always be the best financial option. Now let's look more closely at these top reasons one by one, starting with increased cash flow. If you are disciplined enough to invest the monthly savings from having a paid off mortgage, then you could argue that it makes sense to pay off your mortgage quickly. However, most people do not have this discipline and usually increase their current lifestyle with the newfound cash flow instead of investing it like they had planned. Plus, in the years that you were paying an extra $250, $500, or whatever per month towards your mortgage, you have missed out on the compound gains that potentially could have been realized had those funds been invested. The second reason we will cover is gaining that sense of accomplishment. When you pay off your mortgage, it's great to want that feeling of accomplishment. But if your retirement is not yet secured, are you trading a sense of accomplishment now for a sense of struggle in retirement? Before even considering paying off your mortgage quickly, you need to be sure your retirement is secure. There is no sense in paying off your home now only to be forced to sell it in retirement to help pay your bills. The third reason is reduced interest payments. Once your mortgage is paid off, it's bye-bye interest payments, and you could have a potential boatload of interest savings. But what are you saving versus what could you have earned in the market? This is called opportunity cost, and we'll look at this in greater detail in a bit. The fourth reason we will cover is that vulnerability reduction. You are hoping that by eliminating a major debt, you are in turn reducing financial vulnerability in the event of a job loss or unexpected expenses that pop up. However, this financial vulnerability should be the responsibility of your emergency savings and not the funds that could be invested. If you've established a 3 to 6 month emergency fund, you should be in a good position to cover almost any unexpected expense. If you don't have emergency savings, start building that before being in a hurry to pay off your mortgage. For clients of ours that are not yet retired, we encourage them to keep an emergency savings fund that can cover 3 to 6 months of known expenses plus $5,000 in a bank that is separate from their day-to-day operating cash. For our clients that are retired, we keep their emergency savings as part of their conservative investments. We've spoken with a number of people that once that payoff amount on their home gets in the area of like $50,000 to $75,000, they consider paying it off with a lump sum from the retirement assets. Understand that using a lump sum from your investments to pay off your mortgage can actually serve to increase your financial vulnerability as you are simply tying up your liquid assets in your home. Plus, you lose the power of compound interest from those funds forever. Peace of mind. Of all the reasons people want to accelerate their mortgage payments, this is the reason with the most rationale and the reason we hear most often. So if you have the means and your retirement is secure and you will sleep better at night, then paying off your mortgage is not a bad option. However, we are here to cover the best financial decision. So it boils down to an analysis of opportunity cost. So let's define what an opportunity cost is. An opportunity cost is the potential benefits that an individual, investor, or business misses out on when choosing one alternative over another. While it is true that eliminating mortgage debt saves interest expense and reduces stress, it often comes at a significant opportunity cost. You should consider what the funds used to pay off your mortgage could have otherwise accomplished. Now, we do realize that mortgage rates have gone up quite a bit in the last few years. However, your anticipated rate of return on your investments is likely greater than the interest rate on your mortgage. Considering the historical average rate of return of an S&P 500 index fund is close to 10%, you could be missing out on a 10% annual compound gain in exchange for saving interest expense equal to your mortgage rate. And, as I alluded to before, if you took a lump sum out of your investments to pay down your mortgage, the compound gains on those dollars are gone forever. Plus, any tax you would pay on the lump sum distributions from an IRA or other taxable account. Dipping into retirement savings means missing out on potential gains. That's a serious opportunity cost. There may also be some tax benefits that you could lose by paying off your mortgage if you itemize your deductions. So, would you rather give your money the potential to earn 9, 10, or 12%, or would you rather simply save the amount of your mortgage rate? Before you answer, let's look at some numbers. Looking at this mortgage example, we'll see what you'll be able to save in interest by throwing another $500 per month at the principal. All right, now I know this slide looks intimidating with all those numbers on there. So I will do my best to walk you through it in an entertaining way, as I know not everyone are necessarily numbers people. So let's use a theoretical example here using Kathy and Greg. They find this great couple bedroom house with that big kitchen that Kathy wants and the finished basement turned man cave Greg wants, all for a steal of a price, needing a $300,000 mortgage. Greg has got some connections down at the bank and they are able to utilize them to get a 5.5% 30-year mortgage rate. Wow, this couple's on fire. So given the inputs we just covered, Kathy and Greg's monthly mortgage payment would be $1,700, meaning that over the course of 30 years, they would pay a total of $613,000. Now, Greg has always kind of been a pusher. He wants this house paid off and talks with Kathy about adding another $500 to their monthly payment. That would mean for every payment, they would pay $2,200. And that would mean they would be able to pay off their new fantastic dream house over a course of less than 18 years. Woohoo! That would mean they were able to save $142,000 and 12 years of payments on their house. It doesn't seem like this couple can be stopped. But what if this couple instead took that extra $500 and invested it? If Kathy and Greg instead decided to invest that extra $500 per month into the market using that historical 10% return we talked about from the article earlier, do we think that they would be better or worse off? Let's find out. Investing $500 per month for 30 years means that they would have invested a total of $180,500 into the market. Now, growing those contributions at that historical 10% rate gives them over $1 million at the end of 30 years. And then taking off the amount invested, we are left with over $850,000 in growth. Wow. So let's compare. What do you think Kathy and Greg would rather? The $850,000 of growth or the savings of $140,000? All right. Well, now you may be thinking, hold on a second here, Daniel. In the savings scenario, I still have 12 years to invest that $2,200 per month I saved from paying off my mortgage early. So that has to be better, right? Well, let's take a look. So if Kathy and Greg are now disciplined enough to invest that $2,200 per month they would have paid on their mortgage into the market for 12 years, let's see what it would grow to. The final balance would be nearly $600,000 on an investment of $320,000 over those 12 years, meaning that the total growth they would have realized would be nearly $280,000. Not bad. So combining the interest savings of the $140,000 from the accelerated payments and the growth of the $280,000 means our example couple would be up $420,000. Now, that is a little less than half of what investing the $500 per month for 30 years turns into at nearly $860,000. Wow. Now, that's how our power couple of Kathy and Greg gets it done by making a simple, sound financial decision of investing that extra $500 in the market versus tying it up in their dream house to set them up for taking care of their grandkids a little down the road. Bottom line is there's no one-size-fits-all approach. Financial advisors like us at Hendricks Wealth and Estate Management can provide guidance that balances debt reduction with proper investment management, which can ultimately help you smile through your retirement years and not sigh. While both options we discussed, investing versus paying off your mortgage quickly, are truly good decisions, we feel that investing, rather than making accelerated payments, is the better financial decision. One of the best assets we have as investors is time. As we saw in the numbers, compound interest can be a very powerful thing. Opportunity cost, or the potential benefit that is forfeited by making one decision over another, should be considered when making financial decisions. Now, it's worth noting that this overall discussion is centered around lower interest debt, generally anything lower than 7 to 8%. It does not apply to high interest debt such as credit cards. At the 20 to 25% interest rates on credit cards, our projected returns on investments cannot compete. The general rule would be to pay off any debt that has a higher than 11 to 12 interest rate quickly. If you need a strategy to attack high interest rate debt, we can help. The best financial decisions are informed ones. Don't let the pressure of a mortgage cloud your judgment. By carefully weighing the pros and the cons, and with the right advice, you can make the best financial decisions, just like Kathy and Greg. So at this time, my team and I are happy to field any questions anyone has. Please feel free also next Wednesday to join us at the same time for Sean's presentation on major life events and how a financial advisor can help. To register for that event, please visit our website at www.hendrickswealth.com and click on the Events tab to register. Thank you. And then to ask a question, there is a bar on the bottom of your screen that should say Q&A and have a little question mark above it. If you click on that and type in your question, we'll be happy to answer. Right. I'll just give you another minute or so to ask any questions.
It looks like there's one question, and the question is, what do you recommend using a home equity line of credit for? Do you want me to take that, or do you want to take it?
You can take it if you're...
Okay. All right, sure. So I'm Jim Hendricks, by the way, owner of Hendricks Wealth and Estate Management. And home equity lines of credit can be very good tools and generally come at interest rates that are lower than the anticipated rate of return we'd get on our investments as well. However, we just want to make sure that in your financial plan, you don't overextend yourselves by doing a home equity line of credit. So usually my general guidance, and it can get more case specific than this, but as a general rule, we look, if you want to use a home equity line of credit to finance something, it's kind of a one-time thing. You don't want to keep going back and using a home equity line of credit over and over and over again for expenses that you might come up with. But if there's a one-time project like a home remodel, or other life event that you want to really fund for, then yes, we're in favor of using a home equity line of credit. We generally recommend that people go to credit unions for those rather than traditional banks. You can sometimes get a better rate from a credit union than you can a brick and mortar bank, but it's a good to shop around for those rates. And then again, we just make our minimum payments on those over time and try to invest the difference. And it certainly usually will end up better, working out better than making a lump sum payment for whatever project that might be. Because again, you can get the market level rates of interest that Dan was talking about through this presentation rather than saving the interest expense that goes along with having by avoiding a home equity line of credit. So
Thank you, Jim.
it looks like we have another one. Should I pay down to lower credit card debt? Uh, Pay down, we'll assume that you're talking about credit card debt. Should I pay down my credit card debt? Yes, we always want people paying down their credit card debt before they really do anything else in their financial lives because credit card loans are typically at very, very high rates of interest, oftentimes north of 20%. And there's no investment return that we can show you that'll get you 20% annualized. So we generally want you to pay off your credit card debts as quickly as you can. We try to, one of our things we'll say quite often around here is if you have credit cards, we'd actually prefer you not to use the credit cards because the credit card is kind of like your shovel. So if you don't want to use if you want to dig a hole, don't use the shovel. So your credit card is like your shovel. You don't want to dig a hole, don't use the shovel. It looks like we have some clarity on that question. So they meant, should I pay down my credit card debt with a home equity loan? Yes, as long as you stop using the credit card. So a lot of times what we'll find is people will use their home equity as a get out of jail free card with their credit card debt, but then a couple years go by and they're right back in the same situation again, and now they've got no more equity in their home to tap into. So the most important thing is to act responsibly and reasonably with your credit cards. Make sure you're not going to dig yourself into that proverbial hole again. And then we are okay with using home equity as a resource to get out of credit card debt, but you can't really borrow yourself out of debt. So the more important thing is that you act responsibly with your debts, and we have a plan in place for you to be able to do so and stop making purchases that might be more than what your cash flow allows for. Okay, no more questions.
All right. Well, thank you, Jim, and I'll wrap us up and say thank you to everybody for attending our presentation. And if you have any questions in the future, always feel free to reach out. You can give us a call at the number listed, or check us out at our website www.hendrickswealth.com/events. And look forward to seeing you next time. Have a good day. Thank you for joining us. Bye. Tom, if you're still here, can you end the live stream? Thank you.